Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters.
And we are back. Episode 172 of Carson's Facts versus Feelings. Sonu and Ryan. Sonu, we had some... What is that noise, Sonu? You building something?
I don't know.
Is that your house? What is that? You building something?
I'm not building anything. Oh, you know what? It may be the snow folks outside. They're throwing ice and clearing snow. Sorry. Yeah.
We,
so that noise is... You want me to go tell them to shut it?
Tell them that one of the top 23 podcasts for financial advisors in 2026 is recording right now. You want to talk about that for a second, Sonu?
Let's do it. Thank you, Michael Kitces, second year running, one of the top 23 podcasts for financial advisors, I guess, you know. Mm-hmm. But it's an honor to be right next to, we are big fans of Compound and Friends.
Oh, yeah.
Josh Brown, Michael Batnick, that whole crew there, they do amazing work. So just having our picture next to theirs is something else. And then the folks up in Canada, Rational Reminder, they do a great job as well. They've been, we're like the new kids on the block. Right. But, thank you, Michael Kitces. It's an honor. And thank you all for your support.
Yeah, it was neat to see that. We did make it last year, and I kind of half wonder if we're going to make it again. And then sure enough, on LinkedIn, maybe 24 hours ago, give or take, I got the alert that we did. So thank you, Michael, and thanks to all the listeners out there. So this one we titled, "Are they done moving the snow?" I don't hear it anymore. Did they clean it all off for you?
So far, you never know. It's Chicago, so it may start snowing at any point.
Yeah, that's true. That is true.
So it is like 0 degrees. Are you getting slammed? Did you?
Oh, yeah. I mean, my kids, I don't think they're ever going to have school again. I mean, it's just too cold. They just keep canceling because it's too cold. And I look at it's like negative every day going out to whenever. We got like 9 inches of snow in Cincinnati, but it's just so cold. They're canceling. So they haven't had school the last 2 days, and I don't know about tomorrow. So we will see. But you know what? Here's a good title. We came up with this. Sonu and I messaged each other many times on this. I thought it was kind of good. Reeder or not, gold shines and Shutdown looms. Those who get the joke, Rieder is potentially the next Fed chairperson. But so I kind of want to start with gold and silver. Yesterday morning, which was Monday, the whole nation is kind of snowed in. Not the whole nation, but most of the nation. Most of the nation is snowed in, cold, freezing. And then you look, and equity markets are kind of bouncing a little bit, but gold's going bonkers, and silver's absolutely going crazy. I think it was up like 14% at one point, like one of the best days since '85. I looked at like call options, overall option volume, over like SLV, the silver ETF, all these hit like all-time highs in terms of volume. So right away, it's like, okay, maybe it's a near-term peak. Chris Kimball, friend of the show, obviously joined us late last year. Chris has had kind of I won't get too geeky on you, but Chris talked about Fibonacci and Fibonacci numbers. He's been saying 123 for a while is a logical place where gold might find some type of a major peak. It didn't quite get to 123. Sorry. So, yeah, that's a big difference.
we don't want gold to be at 123.
We blew through that one. You're right. Hey, sorry. So Chris has been talking about that 123 level to me for a long time, and Chris has been pretty right. Anyway, so you got all this stuff swirling, and then you look today, and silver's down 8%, about at 105. Hey, no one's complaining. It's been in silver for a while. Maybe we had a near-term major capitulation silver peak. I don't think silver's done. Maybe it's done for a little bit. Let's put it that way. What's your take on the metals and mining and silver and all that stuff going on?
It's all going up. And I'm a
Thank you. He has a PhD, everyone. He has a PhD.
Oil's going up. Natural gas is up like 44%. Silver is up. I don't know, like some crazy amount. Gold is up like 15, 17% for the year. Maybe it's 17, 18%, something like that. Yeah. And silver is like a leveraged gold play. And by the way, side note, maybe we'll talk about inflation later. I swear I'm going to mute any bugger who, talks about true-flation right now. Right? Please. You have all these commodities going up. Everything, metals, aluminum, copper, silver, gold, oil, natural gas, and people are like, oh, inflation's going down. Sorry, no, that's not happening, right? But anyway, there's momentum. I think part of it, the gold story, we've been talking about it for, goodness, 3 years. probably near on 3 years, right?
Yeah. Mm-hmm.
March 31st, 2023 is when we first included it in our tactical portfolios. At that time, it was like, you know what? We don't like treasuries. We don't want to add,
Right.
we don't think that correlation between stocks and bonds will be the same as it was over the last decade.
Mm-hmm.
But we need some portfolio protection when we are overweight equities. What was the best form of protection that we thought would play that role? It was gold.
Yeah.
And we included gold. And last year, we actually re-upped gold in our strategic portfolios. At that time, we talked about, the debasement trade, right? Everyone laughs at the debasement trade. Here, very simply, here's what I think is happening. Inflation's elevated, massive fiscal deficits. There's more fiscal spending coming, tax cuts, all of that. The Fed we'll talk about the Fed and Rider's on the storm, Rider's storming ahead. I have that Doors song in my head, by the way. So, but the Fed is under pressure to drop rates. We have fiscal deficits in the middle of elevated inflation. All these commodity prices are going up. I don't think inflation's going down. So, I think this is a good environment for gold. In fact, this, I think, is the ideal environment for gold. If you take the counterfactual, I think what could push gold prices, last thing, what could push gold prices down? Tomorrow, if Powell comes and says, we are thinking about rate hikes, I think gold gets killed.
Yeah.
Right? Tomorrow, if Congress comes and says, you know what, we are cutting spending. Right? We are trying to push the fiscal balance into a surplus. Yeah. Like you can figure out the odds of that happening, but unless that happens, I don't think gold goes down.
Yeah. Well said there. On the YouTube channel right now, Drew over at Pod Pony, we can put up the Wall Street Journal article. It says business and finance right at the top. Gold loses status as haven. Talking about how gold's no longer a safe haven. This was in late 2022, everyone. Gold was trading around $1,700 an ounce. If my math is right, it's up ballpark approximate 200% since then. That was the attitude of gold back then. Clearly still different. I will say, the blow off top potentially in silver caught my attention a little bit. Gold and silver, not the same thing. I'm aware they're cousins. I did see Peter Schiff has been making the rounds on some very big podcasts. Now,
somebody finally got him on after 20 years.
Exactly. Peter Schiff's been talking about gold forever. And listen, it has been working, no doubt about it. But I will say, kind of like when you see certain big time bears in the media, at certain points, usually the market's down. Usually, like, okay, he's on TV. Well, let's buy. I do have a little worry now that Peter Schiff is starting to be out there a little bit more, but more power to him. He has been saying to own gold in the portfolio for a long time, but so have we. I mean, we've been saying that too. We manage real money, right? And I know Barry on our team did a lot of numbers. We can't give them away because honestly, I don't know off the top of my head, but Barry pointed out the alpha that owning metals and mining have created for the real money that we run for our Carson partners the last 3 years. I mean, Sonu, it was a lot. I mean, it's why we've outperformed, really.
Yeah.
I mean,
I mean, just year to date, it's added 40, 50 basis points of alpha. And this is excess performance, right? And that's a big deal. It's not like
when you manage money, 50 basis points in 1 month is a really big deal.
And these are not large positions, by the way. You put all this together, maybe it's 6%, 7%, let's say in a 60-40 type portfolio. You're not talking about big positions here, right? We're not going crazy. We do manage real money. We have to worry about risk. We're not going crazy with this stuff, right? We're not putting 20% of the portfolio into gold.
Oh, man, we should have.
We should have. But, one point on your, that headline that you shared, the Wall Street Journal talking about, gold is no longer a haven demand. I have another chart. Drew, maybe we can put this up. This shows the US dollar versus gold as a share of global central bank reserves.
Interesting.
So US dollar claims, and these are usually treasuries, as a percentage share of global reserves. So these are foreign central banks, how much of reserves they hold. The US dollar claims have fallen from about 50% in 2023. So it was half of all reserves to about 40% in just over 2 years. It's been falling since 2017. It fell from about 55% in 2017 to about 50% in 2023. Right now, it's about 40%. The big drop-off has come on in the last year and a half. Meanwhile, gold share of reserves has increased from 15% a couple of years ago to about 25%. It's gone from, let's say, 15% to about a quarter of global reserves right now. So much for that headline. And it's pretty much 1-to-1, right? US dollar reserves have been falling, but it's not like other central banks are saying, we like the euro, we like the yen. No, they're not saying that. Instead, they're going to gold.
Right. Well, and it doesn't seem to be slowing down, I guess is the way to put it. We had, why do I always forget? Warren Pies. I'm sorry, Warren. I don't know why I always forget Warren Pies' name. I got his face right there. He's like the strongest guy ever on our podcast. Anyway, Warren Pies back in March. I remember doing, because I was in, it was early March. I was in Arizona with my boys at a kind of a work trip, but I brought my boys to go see the Cincinnati Reds for spring training. Remember doing that in a hotel with Warren Pies while a storm happened outside. Rain. It rains like 2 days a year in Arizona. I went one of the days, it rained. I flew 2,100 miles to see a baseball game, and it got rained out in a place that never rains.
Ouch.
Now, Sonu, we're going to try it again. We're going to try it again.
Okay.
Same thing. My boys have a long 4-day weekend. We're going to go out to Arizona again, do some work stuff, and then piggyback it with go to a Cincinnati Reds game. I think it's March 5th, whatever that Friday is. So everybody, and they're playing the Giants right there in, I forget the name of the town. Anyway, Scottsdale, sorry. They're playing the Giants right there in Scottsdale. So let's just start praying now that we don't have rain on that first Friday in Arizona, so I can go to Arizona and see the Cincinnati Reds play spring training. What I was getting at, though, a little just getting some good vibes out there for no rain in Arizona in March. What I was getting at was Warren was talking about this debasement thing way back then. Now, listen, we kind of agreed with it. I don't know if we were calling it quite the debasement trade. I think we're going to give Warren his flowers. I think he kind of coined that. I think he might have said someone else did, but close enough for government work. What is the debasement trade? Maybe you've already said it this podcast, but talk to one more time. When people hear debasement trade, what in the world is that?
It's easy to think of that as the dollar is getting debased amidst inflation, right? But I think the way I think about it is, as I said, look, inflation's elevated now. And right now, given everything we are seeing in commodity prices, I mean, we're overweight metals and mining, for example, right? If we go underweight, I'll be like, maybe inflation's heading lower. And by the way, the Fed, I should say, the Fed actually targets headline inflation. Okay. They look at core inflation to get a sense of what direction headline is going, but the target is still headline. And that means energy plays a big role, right? Yeah. All these commodity prices play a big role because they're volatile. Like I said, we're overweight this stuff for a reason. So disinflation is not what we are betting on right now, literally.
No, that's true.
Right? So when inflation's elevated, and the outlook for inflation, I would say at best is quite messy, right? I don't think inflation is going to 4%, but maybe it stays close to 3%. Which by itself would be okay if Congress was trying to, get their head around fiscal deficits and say, you know what, maybe we should cut back spending. And the Federal Reserve is like, maybe we should pause, maybe we should hike rates. Yeah, then I would say that's not debasement. But we have the opposite. We have elevated inflation. We have massive fiscal deficits. We'll talk more about that when we talk about Rieder and stuff like that. We'll compare it to the 90s as well. And the Federal Reserve is under huge pressure to drop interest rates even further. Yeah. That's debasement.
Okay. And it's happening not just in the U.S., though. I mean, like lots of gold is breaking. Yeah, I mean, well, like our friend J.C. Pretz, he's been talking about this for a while, and we've talked about it too. But gold isn't just breaking out the U.S. dollar. Gold broke out, I think it was January, right about 2 years ago, right? Ballpark 2 years ago, gold broke out to new highs. And look how it's done the last 2 years. That was relative to the dollar. But then you look like in late 24, early 25, gold started breaking out to new highs against just about every currency. Maybe there's one out there it didn't make a new high on. But when it was doing that, that's a real true bull market when you talk about metals, because yes, we all talk about priced in dollar because, well, look where we live, but other people price it in different things. And when you do that, it has been going higher. Do you want to talk a little more inflation, or do you want to go the Rieder route? Or what
Let's go the Rieder route. But one final point on exactly what you said. Like it's not just US, right? Debasement. We are seeing the same thing in Japan, fiscal deficits. What happened to bond yields? Bond yields went up, the currency actually, normally you think that when bond yields go up, the currency would also go up because it makes it more attractive.
We're talking about Japan right now, right? You're talking about Japan. Yes. So you think the yen should go higher is what they specify.
The yen should, the yen should go higher, but it didn't go higher, when all that fracas happened last week. But I should say, when you say global markets, all of this stuff, at least for now, is good for stocks.
Oh, yeah.
Look at the Nikkei. The Nikkei actually did well during this time. Right. A couple of years ago, or year and a half ago, when you talk about the yen carry trade crisis, the Nikkei had crashed. That's not happening right now. The S&P 500 is very close to all-time highs. Yeah, tech struggling a little bit. I think tech is coming back maybe as we speak.
Yeah.
All of this stuff, inflationary growth, which is literally what we wrote in our 2026 outlook, That's good for metals. And I think it's good for stocks as well.
Now, what did you call it? You've used the word kerfluffle before. What was
Fracas?
fracas? Okay, so let's put a pin in that for a second. So I was on CNBC. I guess it was Friday. So what is today?
Okay.
Tuesday, last Friday. And they had different hosts on Squawk Box because the regular crew was over in Davos. They had some new ones, not new ones, but different people filling in. And it was great. I thought it was a good conversation. I enjoyed listening before I was live, just listening, And Brian Sullivan, I love Brian Sullivan. I think he's hilarious. I truly think Brian Sullivan's the funniest guy on TV. I get along with him really well because we both kind of like to have a little fun sometimes. And Steve Leisman said something like kerfluffle about who knows, the government, who knows, kerfluffle, and just off the cuff, live on TV. Sully goes, kerfluffle. What wasn't that Big Bird's best friend? I don't know if it's true or not. It was so funny. And I'm like about to go on air just giggling because I thought it was so. Now, every time I hear kerfluffle, maybe you do too now, everyone. This is a word we use in this world. I'm going to think of Brian Sullivan saying, wasn't that Big Bird's best friend? I don't know. Maybe let us know in the comments on YouTube. Let us know who Big Bird's best friend was. But we're going to say it's kerfluffle. All right, Sonu, we're going all over the place. Let's talk about that F word, the Fed. I'll set the stage. Rick Rieder was like a 5% chance like a week or two ago, and now he's ballpark forward. I know you've got the exact numbers.
48%.
Oh, wow, it's even higher. Okay. He's the CIO of fixed income over at BlackRock. Pretty big shop, BlackRock.
Kind of, yeah.
Kind of big. In the running, at least as of now, we still have what is own writing. Warsh, Waller, and Hassett. Sounds like Hassett might be kind of moving out of that, but those are still the four technically. He's in charge of, according to the data, 2.7 trillion with a T, 2.7 trillion in AUM. So he's managed a lot of money. What else do I have on him here?
I thought 2.7 trillion. Yeah. That's kind of like the Fed's balance sheet too. So it's like it's
a lot of money
between BlackRock and managing the Fed's balance sheet. I mean,
Yeah, he is quote unquote more dovish if you listen to some of his interviews, which I think President Trump probably.
They all are, right?
Well, you better be. But he does point out. I kind of agree with some of these concepts. Hard to disagree. I mean, he's saying because of higher productivity, there's AI, logistics, and automation. All these things in the future probably put more of a little bit of a cap on it. I don't think he's quite true-flation level of inflation, but he's saying this stuff. I will say this, and I'll turn to you. What I like about him, he's a communicator. He's on TV all the time. He manages real money, but he also communicates. I think in the world we live in now, communication is more important than ever. So he's real world. I don't know if he has a doctorate or PhD. He might, but nonetheless, he's more real world, manages money, knows how to communicate and talk to people. And I don't think he's going to be set in his ways. Maybe to get the job, you have to wink, wink. I'll give you a rate cut or two. That's just kind of what has to happen. But maybe once he's in the job for a while, he'll let the data come to him and use it. That's what we all want. We want someone who's not just going to do whatever your boss tells you. Although Sonu and I, of course, always do what our bosses tell us. But
yes,
when you're in charge of the Fed, I don't want that. I guess your boss is the president. Everyone knows, read between the lines, what I'm trying to say here. We want you to follow the data and do what's best for our country, best for our economy, best for inflation, best for
Looks like you're describing somebody we know well, which is Jerome Powell.
Yeah, there you go. Well, he's ready to get out of there. All right, I set it up. I don't know where I set it up.
Thrown out of there.
Thrown out. Well, he might stick around. We'll see. He can stay on a governor. Anyway, so what's your take on Rieder and everything else with the Fed? Because again, 2 weeks ago, we weren't even considering him, honestly, and now he's a coin flip. Yeah, what do you think?
Hey, Drew, let's put up this chart. Fed chair horse race. Rick Rieder right now is at 48%. Kevin Warsh, who Rieder displaced, was at 27%. Kevin Hassett, who Kevin Warsh displaced, is currently at 6%.
You lost me. Okay.
Chris Waller, who Hassett displaced, was at 10%. So we played these musical chairs, right? Yeah. Look, I think it's actually notable that no candidate is over 50%. And you think normally betting markets is the collective wisdom.
Yeah.
But I don't think it's reflecting any sort of quote unquote wisdom, right? I think the choice, it just comes down to one person, that is President Trump. And look, Hassett's odds a couple of months ago was 90%. That's collapsed to 6% right now. It tells you that Trump really isn't convinced with his current options, right? And that's why you're seeing all this volatility in betting markets. And Kevin Warsh was up at 60% odds exactly a week ago, right? So let's talk about each of them. Hassett, I think, would be the most likely to give the president what he wants. But for whatever reason, Trump is like, you know what? I like you where you are right now as the head of the National Economic Council. And that's when his odds sort of crash.
Okay.
Then you had Kevin Warsh. Historically, the guy has been an inflation hawk. Yes. Even in 2008, 2009, when it was the most ridiculously wrong decision to be that. Be a hawk.
And,
right?
and I'll just chime in just for a second. Friend Neil Dutta over at RenMac, he's obviously had some strong opinions on this one. So like Neil does.
Yeah.
But Neil is we talk about having a boss. Neil is the boss. When you're the boss, you can really say what you want. Neil lets his feelings very clear there.
Maybe Neil should get his hat in the ring.
Oh, we've joked about that. And then he'd come on our podcast. I just want one Fed chairperson on our podcast, and Neil would come on our podcast. So yes,
shout out. I think Neil would make a good Fed chair.
You should be a governor. You and Neil. He can be the main guy. You'll be a governor. You guys will. Yeah, there we go.
Anyway, Kevin Walsh, look, he's making the right noises about, we need to reduce rates right now. For obvious reasons, but his history is not convincing at all, right? Then you got Chris Waller, who I think honestly would probably be the best candidate out there.
That's what I kind of like. I mean, I like him the most. Maybe Rieder, anything more about Rieder, but Waller was always my favorite to begin with out of the other three.
Waller's been kind of right about everything that's happened with the economy and the trajectory of inflation and the labor market over the last 2 years.
Yep.
And look, the Fed chair is just one vote out of 12. You need to be able to convince the rest of the committee members to go along with, in this case, rate cuts. But even he's unlikely to take rates much lower than 3%. And obviously, President Trump wants rates at 1%. Look, nobody's going to give him that.
Right.
But you think, okay, can we get to at least 2.5%? Yeah, so I think that's why Rick Rieder has come in as this dark horse candidate. He's, like you said, he's made some comments about taking rates down below 3% on the back of productivity growth. I want to talk about that. Scott Bessent's been in that same camp. Yeah, we can drop rates below 3%, maybe to 2.5%, 2.75% because of productivity growth. But again, the reality is I don't think even he is likely to push rates as low as Trump wants, which means, hey, over the next week or two, somebody else could come up. Yeah. Right? But anyway, I want to talk about the 90s and productivity growth.
Well, let me jump in. Yeah, let me jump in. I believe I understand this one. You can confirm this. So the president picks them, but they still have to go through the Senate, right? They still need to be confirmed by the Senate. Now, Republicans have 53 seats, Democrats 47. We can go back in history, and this is usually you don't necessarily
probably get confirmed, I think.
You don't usually vote by party lines here. I mean, we've seen definitely you can get a lot more votes, maybe if they like you on the Senate. So that's another side to this. But Rick Rieder has a lot of goodwill. He's very well respected, and he just kind of came out of nowhere. Apparently, when did he meet with Trump? Like a week ago, or
something like that? A week ago.
Well, either way,
But like I said, I think it's telling that his odds haven't gone up above 50.
Well, they're waiting for Neil. We're waiting for Neil to put his head in the hat in the ring. Yeah.
Neil Dutta for, I don't think it's going to help if we promote him. Maybe somebody else should. I mean, somebody, those guys know the Treasury Secretary. Maybe Besson could put in a good word for Neil.
That's a good point.
I will be very excited. Yeah. But anyway, like I said, the Fed chair, is just one vote amongst 12. So the chair will have to convince others that rates need to go lower, right?
Okay.
That's going to be a hard task. If the labor market doesn't look like it's breaking. And 2, if inflation remains elevated, right? But that leaves the productivity growth story. And that's what Rieder and Bessent believe will be the rationale, or they believe it's good rationale enough to drop rates. Yes, productivity is high. And that's why they're like, we can do what Greenspan did in the mid-1990s. The logic is that productivity growth will result in lower inflation and higher real wages, right? That's what allowed Greenspan to lower rates in the 90s. But Ryan, here's one thing, and we've talked about that over the last couple of years too. And in 2023, 2024, we saw strong productivity growth. Inflation is coming down. 2025, we actually saw strong productivity growth, but we didn't see lower inflation. Inflation remained elevated about 2.7. By the time core PCE comes out for December, it's going to be about 3% or so. Something else happened in the 1990s, which is not happening right now. One is globalization took off after 1995. Okay. NAFTA came into effect just before that. And then China entered the WTO in 1999. Okay. In fact, I'll put this chart up showing durable goods inflation. Drew, it's PCE inflation for durable goods, 1990 to 2025. You can see from 1990 to 1995, the early 90s, inflation for durable goods was running about 1% to 2% per year. Prices were increasing generally, not crazy, but it was increasing. What happens from 1995 all the way to 2020? Inflation collapsed. It became negative, and prices just went straight down, straight line down.
Right.
Prices just fell for 25 years until we get got the post-COVID inflation surge. And again, in 2025, because of tariffs, it went up. Globalization is reversing right now with all the tariff stuff, right? So that's one reason Greenspan is like, yes, there was productivity growth, but inflation went down. One reason was, you got globalization, you got cheaper goods from abroad. That's not quite the case right now.
Like any good podcast, let me play devil's advocate for a second. You didn't mention the internet. I mean, the internet was one of the more deflationary things we've ever seen. A lot of smart people are saying AI is the next deflationary aspect. How do you square that circle?
I would say the internet, by the time all that happened, was the 2000s.
Okay.
Right.
Yeah, good point.
Especially when you talk about the late 90s. And then, by the way, the internet, yes, it was maybe 2004 when it really worked itself into all of our lives, including professional lives, right? AI, could it do that? Possibly, but that's, I think much later down the line, right? Maybe it's a 28 to 2033 story or something like that. By the way, by the time it really makes its presence felt, right? The other thing that happened in the 90s, the federal government was running a primary surplus. By primary surplus, I mean, if you take the fiscal balance, excluding interest payments. So it's a good way to get a sense of how much Congress and the White House, how much are they actually spending? What are actual fiscal outlays relative to revenue? The fiscal balance was in the positive at that time, in the late 90s. In fact, by the time we got to 1998, 1999, 2000, it was running at like 4 or 5% of GDP, right? Positive. Right now, the fiscal balance is in deficit. It's running close to about 2% deficits. I think that's another reason Congress, the government was spending a lot less money back in the 90s, late 90s especially, and that kept a lid on inflation. Goes back to what we were talking about. We have massive fiscal deficits. We have elevated inflation. The Fed is under pressure to lower rates. That's why gold is also doing what it's doing. Look at what gold did in the mid-90s, right? I mean, that was not the time when gold was doing well. It was the 2000s, actually, when gold went on a big run. 1980s and 1990s is terrible for gold. But that was because inflation was going down, but we didn't have big fiscal spending. That's not the case right now.
Well said. I know gold was up 11 years in a row, right? I think it was one of the longest win streaks for any asset period. And one of the calls that we made 3 years ago was gold and stocks are probably going to go higher together for years. Remember, I was out there saying that, and it got some odd looks. We'll just leave it there. And I pointed out that there are periods like 5 and 6 years in a row where gold and stocks went up in those 2000s, in those aughts. So it's, it is possible, and that's clearly where we are. It's just looking at Terminator and Terminator 2. Apparently, it was August 97 when AI became, is it called sentient? When AI could think for itself, when all the Judgment Day started. And apparently Terminator 1, the war they're talking about, was in 2029. So from these numbers, and I know we're getting there. That's kind of, oh boy, I hope James Cameron's a pretty smart guy. I hope he wasn't that smart. I don't know. I hope he's not that smart. You mentioned when AI really starts taking off, I'm thinking, oh God, here we go. Oh, James Cameron. Oh boy, save us. Anyway, all right. We talked a lot about the Fed, and the Fed meeting this week. We're going to go there. There's not a lot to say, so we probably can make it quick. Do you want to talk about that, or what do you want to do?
I think because of, like I said, going back to the labor market doesn't look like it's breaking. Inflation looks like it's going to stay elevated, especially given what's happening in the commodity complex. So I think this Fed is going to stay on hold. Obviously, this meeting, I think they stay on hold in March, and I think they stay on hold in May. Then Powell goes, and all bets are off.
Yep.
Any normal environment, based on what you see in the data for the labor market, based on the inflation data, I would say the Fed would be maybe thinking about, maybe not raising rates, but at least thinking about it.
Okay.
We're going in the opposite direction. Like I said, it gets back to, why do I think gold is going up? That's exactly why.
Good stuff there. We talked before, midterm years, right? Midterm years historically aren't that great. We've laid into this a lot lately, so I won't say too much more, other than in 2018 and 22, the Fed was more hawkish then, right? So what's the Fed doing now? Well, not so hawkish as we've laid out. What do you want to talk about?
Do you want to talk? We got some inflation data. We got income data. We got consumer spending.
Well, let's go inflation, because I didn't have enough time, but I wanted to buy an "I Believe in Trueflation" T-shirt just to Sonu to just smash his computer. Actually, it's probably about to smash the computer about an hour ago. We have some technical difficulty, but
no kidding.
I didn't have time, but maybe I'll still do that. I believe in Trueflation. What is Trueflation? I know you were fighting back on the X sphere, Twitter sphere on it. What is it exactly?
I don't know. I think without getting into this, like I said before,
Everybody watch. Wait a second. Watch YouTube. Watch Sonu get redder. I don't know. Do you get red? Can you even get red, Sonu?
Red?
I don't know. We're about to find out if my good friend Sonu can even get red. Watch him on YouTube right now when he talks about this.
No, look, it's measuring a bunch of goods prices. It's collecting a whole bunch of goods prices, but from across the web, you could say, you know what, I collected 1 million prices, but if it's like prices for 1 million versions of cardboard, that's not going to help. You want a diverse basket of goods and services, by the way, right? And that gets to the inflation data. Yes, core goods inflation has been running harder. That's because of tariffs. I mean, no surprise, right? We know that. And, it's durable goods inflation over the last 12 months is running about 1.2%. That doesn't seem like a lot, but it was negative 1.3% in 2024. So you're talking about a 2.5 percentage point swing to the positive. So that's contributed to elevated inflation in 2025. But I would argue even that's transitory. Fair enough, right? I mean, the Fed probably wouldn't use that word, but I would say, okay, fair enough. That's transitory. The problem is core services outside of housing is running hot. You can say the tariff impact is transitory, all of that, but core services, things like personal care services, childcare, veterinary services, right? All of this stuff, recreational services, concerts, movie theater tickets, all of that makes up about 60% of the core PCE inflation basket. And remember, PCE is what the Fed focuses on. And core inflation, core services inflation, Drew, we can put up this chart, core services X housing, that's running at 3.3%. That's hot. Period. That's just hot. Before the pandemic, 2018, 2019, it was about 2.2%. We're well above that. And final thing on the inflation point, last year, by the time we get December numbers, I think the core PCE index, which is what the Fed looks at, is probably going to clock in around 3% year over year for 2025. That's come despite, one, oil prices going down, and shelter disinflation. We got a lot of shelter disinflation. I would argue we even got a pull forward of that because of the assumptions the BLS made, October, because of the shutdown. And see, we can talk about the shutdown here too.
Yeah, I've got the shutdown. Shutdown's coming. We'll get there.
Because of the shutdown, we didn't get data in October. And so the BLS said, you know what? We think shelter inflation was 0 in October, right? And that seeped into November as well. So we got a big positive tailwind from shelter disinflation. That was expected. Look, that was coming anyway. That was going to come in 2026. But we got the pull forward. That's okay. It is what it is. But despite that, core inflation is running close to 3%. Think about that, right? And now all of this other stuff is happening. I mean, I don't even think, I look at core services inflation, including things like restaurant prices, right?
Of course you look at restaurant prices. I mean, look at it. So do I.
I know. Restaurant prices are running quite hot. It's running about like 4.5%, well above what you would think is normal. I think, that tells me maybe the labor market is not as weak as, the hiring data is suggesting. I'm not saying it's in a great place. But I don't think it's that weak either.
Well, we talked about.
I'll pause there. I'll stop talking.
No, good stuff. I mean, we talked about that a week or two ago. We've finally had 2 months in a row of positive jobs growth. Listen, not by a ton, but at least we stopped at 7 months in a row of up, down, up, down, up, down. I think, who was it? ADP. ADP says small businesses actually hired more people last month for the first time in like 7 months. So there's little nuggets at the labor. And by the way, initial claims are always around 200,000, and continuing claims have actually been going a little bit lower too. So there are some clues that the labor market isn't maybe as bad as they're telling us on TV. I don't have too much more to say on that. You want to let's talk about the market a little bit. Yeah. And then we'll talk about the government shutdown and earnings season. Maybe that's where we'll go. Drew, on the YouTube channel, you can put up the January barometer chart. Maybe you don't even have it yet, Drew, but this is...
How many days? We just have 3 days. Looking good, right?
We're looking really good.
Fingers crossed.
Yeah, as you can see on the YouTube channel, when January's higher, the next 11 months are up almost 87% of the time, and those next 11 months are higher, like 12% on average, much better than your at any time returns. No, everyone, yes, we manage billions of dollars. We don't blindly invest in the January barometer. I'll be very, very clear. If you listen to this podcast, there's a lot of other things we look at, but I just stack it on top of, that sounds bullish when you put it with everything else, is where I put that. And again, that's a positive thing. We'll see. Hopefully we don't jinx it, get some drama out of Washington. They'll all mess it up. It could happen. But as of now, it's looking like we're going to have a positive January. We'll talk
Looks like
about
President Trump is trying to, like, yesterday, was it yesterday? Yesterday, we were recording this on the 27th. It was like 25% tariffs on South Korean goods, right? I was like, what?
Nobody even listened to it. Yeah.
I was like, let's not do this again. Can we just get through the next 3 days with a positive January, and then we are hopefully off to the races?
Exactly. Also some interesting concepts when we talk about technology, right? Tech is lagged. We get it. We know that. Then you look at like the NASDAQ 100, don't have a chart of it, just visualize it, everyone. Had a major peak in late October, virtually gone sideways for several months. Well, to me, it's just biding time. I think large cap tech, it's just biding time. We are even weight technology. We've said like a broken record. When you do tech adjacent things, we're probably slightly overweight. I think that still makes sense in this environment. I think tech is just biding its time before it kind of takes back that baton. Oh, by the way, speaking of tech, I was on CNBC yesterday with our buddy Dan Ives. Take a wild guess who's still bullish tech. So we'll just leave it there.
You think?
Yeah, you think? Yeah. Exactly. Yeah.
Well, we are too, right?
No, we are. We're not
fun of Dan, but
we're not Dan Ives. We're not Dan Ives bullish tech, but nobody is. But hey, he's been pretty right. So you look at tech, it's kind of fascinating to me, Sonu, because large cap tech, yes, it has quote unquote struggled on a relative basis, this lag. But then you look at like tech equal weight and small cap tech both last week broke out to new highs. That might sound familiar because financials have been lagging. JC Prince mentioned a couple times. He looks at like relative strength, like staples relative to financials, large cap financials. Well, that hit a 5-month, I guess in this particular case, high, or if you did financials relative to what I'm getting at is staples are outperforming financials right now by a pretty wide margin. And that's kind of inner market stuff. You don't always want to see that. But then if you look at small financials, specifically regional banks, they're breaking out. They're breaking out to like multi-year highs, maybe even all-time highs. Not 100% sure off the top of my head, but a lot of strength. So we've got this. Honestly, you could give any story you want, but I think to say tech is weak is not as clear as it sounds because equal weight's doing well, small caps do well. It's the Mag 7, who, by the way, all have earnings this week. Not all, sorry, 4 of them have earnings, and the other ones are coming up that are probably going to be positive. We'll see how the market takes it. What is your take on the tech lag? Oh, you know what? One more. I love stats and funny little anecdotes, if you will. Ron DeSantis, the governor down in Florida, he came on X on October 29th and informed everyone on X only 7 stocks are going up anymore. And
He's saw not listening to you.
I said, you gotta be kidding me. I said, when that happened, I mean, it wasn't true then. It's never been true. Take a look at when the relative strength of the Mag 7 peaked. Everyone, it was October 29th. I mean, you cannot make this up. That they stopped leading the day a governor who's, he has different jobs, but telling us technical analysis is not one of them. That's when that contrarian bells were ringing in a big way to me. So it's kind of funny. But what's your take on tech here? Let's go.
I think it comes back. I think it comes back for a couple of.
Given our models, we better say that. Honestly, but like I said, honestly, I'm kind of impressed. Our models doing just fine this year. In fact, pretty good. And tech hasn't done that well. If you would have told me small caps up like 8% and S&P's up like 1%, that's all I knew. I would have said, "Ooh, I bet our models are struggling this year." Thank God, that's not the case at all. We're doing pretty well actually. So
overweight equities. We have a lot of tech, but we also have a lot of metals and mining. I would say, obviously, one surprise for me is how quickly and how fast metals have gone up, but set that aside. But I am a little surprised by financials. But I think there's some policy risks there, similar to what we're seeing in the healthcare complex today, right? Healthcare is just getting slammed, at least some companies, right? But you look at tech, coming back to tech, I look at some of the individual names, how far they are from their 52-week high. Microsoft, it's down about 14%. None of this is a recommendation. NVIDIA down about 11%. Apple down 10%. Broadcom down 20%. AMD slightly better, about 5.5%. IBM's down 9% from all-time highs. Oracle's down 49%. Ryan Palantir's down 19% from all-time highs. So yes, there's a struggle, but something you shared with our advisors on our regular macro Monday morning calls struck me because you were talking about 2027 earnings. How 2027 earnings expectations have been climbing. And for the S&P 500, it's about $358 per share. When we wrote our outlook, we actually put that line in the outlook, like what is the 2027 expectation? 2 months ago when we wrote it, it was about $350 per share.
Wow.
Now
There
it's
you
at
go.
358. So it's like about 2% increase already.
Mm.
And earnings season hasn't even gotten started. And 2027 is actually going to matter as we move into this year because, when you think about next 12-month earnings, every month we progress into 2026, it's going to grab more of 2027 earnings and less of 2026 expectations, right? So 2027 is a big deal. And the fact that it's as elevated as it is, it's about 14% expected growth relative to 2026. That's huge. But what needs to happen for that to materialize? In fact, tech has to come back because tech is a big part of S&P 500 earnings. It's not just prices and market cap. It's also earnings and revenue and profits and all of that, right? So I think tech comes back. Otherwise, we're all wrong. And 2027 earnings expectations will collapse. In fact, it's going the other way. Now I think prices catch up. I think tech rallies from here.
Yeah, I'm in that camp too. Good stuff there. I will say, I guess I'll do a little promo. This Friday, so Friday the 30th, the 30th, the last day of the month, we're doing a special Facts versus Feelings live stream. We're calling it Social Hour. We're going to try to do this on a Friday, maybe the last Friday of each month, an hour before the close, at 2 o'clock Central, 3 o'clock Eastern time. We're going to be joined by Mr. Brian Belsky for the very first one. That should be amazing and awesome. And I will say, like in the YouTube comments, maybe I'll add a link to it, but I think we added a link to your daughter's cookies a week or two ago, and I think YouTube takes that away. I think YouTube doesn't sometimes you do those links. I think that's what it is.
Yeah, so she's still selling cookies, everyone. If you care for Girl Scout cookies,
really?
I'll put the link up. I'll try to put the link up. No pressure. I mean, if you have a sweet tooth, I do. Well, tagalongs. Like I do like the lemon cookies though. So
I think it's Adventurefuls, Adventuresomes. I don't know. I ordered those from.
Did you get yours by the way?
Yes, from your daughter. I did. I got them. The Adventure somethings. They were pretty good. They're new. They're like Oreos. They're like an Oreo. Like that's an Oreo, but nonetheless, that's another word for it. It's like Kleenex tissue, Adventuresomes, Oreo, same stuff. Anyway, but no, they were.
Speaking of eating,
are
you grabbing a drink this Friday?
Yeah, I think we should. Yeah, I think it's going to be more of a happy hour.
Yeah,
exactly. So, but this Friday, an hour before the close, we'll be promoting it all over our socials. Hopefully you've seen it. But again, a live Facts versus Feelings will be a lot of fun. Something we've been wanting to do for a while. It's more live.
You should have a game or something. Like, guess the drink we'll show up with or something.
Oh, my goodness. I don't know. Yeah. I mean, do a shot every time Belsky says the word bullish. I don't know. I better do that. All right. So
people ask him about tech. I'm curious. Is he bullish tech? I guess we'll find out. Find out.
Let's talk about healthcare just for a second because it is in the news. So the news came out that Medicare prices for next year, I believe, are going to be up 0.09%. So let's just call it flat. Now next year is 2027. So virtually, not a big jump. Now that is going to pressure a lot of these margins on like United Healthcare, for instance. Not a recommendation, but the Dow is down the time we're doing this because United Healthcare is down a lot. The rest of the market's up. Okay. So healthcare, I mean, every time I've said this before in our team and on this, every time I think, oh yeah, healthcare is looking good, something like this happens. There is a lot of policy stuff when it comes to healthcare, which can be good or bad. Let's be very clear. It can be good or bad. But what you have a high take on that other than it's pressuring a group that honestly it's kind of lagged. Some of those, the HMOs have lagged for a while.
It was lagging. It was sort of coming back, and then boom, here we go again. I think it highlights policy risk in a midterm year. We're in a midterm year. We've talked about this a lot. That we're seeing any number of policies come in, and the general theme being the administration wants to improve affordability. So from that perspective, well-intentioned, but how you get there is a different question. Like, how do you drop prices? Well, compress margins, right? Whether it's margins for healthcare providers, whether it's margins for financial companies by capping credit card interest rates. There's a reason financials are struggling. I think that's a surprise. We're talking about an inflationary growth economy, and we're talking about, the yield curve steepening. If you just tell me, hey, Sonu, the yield curve is steepening, that would be a good environment for financials. Yeah, JP Morgan's down 11% from all-time highs. Visa's down 13%. Berkshire is down 12%. Bank of America down 10%. Wells Fargo also down 10% from all-time highs, right? So there's clearly a bit of a struggle in that financial sector complex. It's not participating in this rally. And, as I said, the S&P 500 is close to all-time highs.
Well, the president's literally suing J.P. Morgan for $5 billion also, so you don't see that
Oh,
every
is
day.
he?
Yeah.
Wait, what is that about?
Oh, you didn't hear this one? He's
I
suing
didn't hear
Jamie
that
Dimon
one.
and J.P. Morgan.
I can't keep track of it.
Well, we'll just leave it there. But they
So no
apparently
wonder Jamie Diamond's not going to be in the horse race for Fed chair, is my guess.
not anymore. I guess Diamond said some sort of negative comments about some things. You can go look this stuff up. Over in Davos, the very next day or two, there was that lawsuit brought out. So anyway, yeah. Go figure. All right, so we didn't talk about earnings. I want to wrap up earnings, and we'll talk about the shutdown, and we'll end this week. You already kind of laid out estimates, right, for 2027 have been going up even before earnings season started. That usually isn't how this works. Earnings season, yes, it's super duper early. By the time people listen to this, we'll have had probably a lot of the big tech names, so we're gonna have more of a clue. But like 13 or 14% of the S&P 500 had been in as of last week. 75% beat. Expect to be about 8.5% earnings growth. Good chance we're going to see double-digit earnings growth and all said and done. That'll be 4 quarters in a row of double-digit earnings growth. Anything else? One more from me, Sonu, then I'll turn it to you. Look at the Mag 7, right? The Mag 7 is supposed to have earnings up about 20% this quarter. The 493 is ballpark 4 to 5%. I think one of the things that'll happen when we look up, most of the big beats, I think, are going to come from the 493. I think the 493, the rest of this economy are going to come in strong and justify kind of why the 493, the equal weights have done a lot better. But I'm sure tech will do just fine too. What are you looking for this earnings season? And then we'll wrap it up with the shutdown.
Mostly the gap between profit growth for companies with more revenue coming from outside the US versus companies with more revenue coming from within the US. You shared this chart. Maybe we'll put this chart, Drew, up. Ryan can send you the chart. He shared this with our advisors. I thought that was interesting. It's part of our story too. It's part of our outlook story. Global economic activities picking up. That's not only good for global equities and the global bull market, but it's also good for US multinationals. And by the way, some of the biggest multinationals are also tech companies, right? So there is that, but also things like materials companies, right? So I think it's all playing into that same theme. Global economic activities picking up, commodity prices picking up, global bull market, right? Not so good for bonds, but good for gold as well. So I think that's what I'm looking for with respect to earnings. One thing I'm keeping my eye on generally from a macro perspective, I don't really dive into earnings transcripts and things like that. I don't listen to all that unless, we have folks on the team and they sometimes share some, great things that come out of those earnings calls. But otherwise, I'm looking at big picture stuff and this is one of them.
Yeah, you and I are more top down strategists. Means you look at the big picture and go down. Bottom up strategists means you might look at individual companies and micro things and work your way up. But what the chart, we can put the chart back up now, Drew, because I want to pull up to describe what Sonu was saying. S&P 500 earnings, according to FactSet, are supposed to be 8.2% in the fourth quarter, year over year. If more than half of a company's revenue comes from outside the U.S., so again, they're dependent on the rest of the world, those earnings are supposed to be up, Sonu, 12.6%. So a lot higher. Okay. If more than half of your revenue comes from inside the United States, so more domestic by nature company, your earnings then are only air quotes, only supposed to be up 5.5%. So again, it's a neat chart, and one that you said a couple of years ago was exactly flip-flop to this. But this tells us the global economy is pretty good shape, right? Is that how you see that potentially?
Yeah, exactly. And it's good for the U.S., especially U.S. large caps. This is where, there's a reason we do like U.S. large caps. And this is, one reason. Global economic activity is picking up. I mean, we do like foreign equities too. We are neutral, U.S. versus international, which means we probably have more international equity exposure than most other folks in this business managing models. You probably have it's like a 70-30 split, right? Yeah. And I think a lot of people probably be uncomfortable with 30% international equities, especially when you look at the last 10 years, like, wait a minute, I know international equities outperformed in 2025, but look at 2010 to 2024, right? But I think, look, we're not underweight U.S. equities by any stretch, and we are overweight equities. So we are overweight both U.S. and international at the same time, but we are neutral one relative to the other. We're not picking a, like a horse there, to be clear, but we like both.
No, well said. Because again, what happened, a lot of people missed the international rally last year. Then you look at history, and we've had these blips like 2017, for instance, where 1 year the rest of the globe does well. Then what happens? The U.S. just takes the baton. I think we'd be okay if the U.S. totally took the baton back, but I think we're going to have a lot more participation. Might be a broken record saying that, but I think there's a lot of other areas doing well. That's why instead of just picking one or two, you can pick a basket of things and hopefully still be overweight equities and still benefit.
One thing.
Yeah,
actually, one thing on that topic. Again, we talk about the weak dollar, right? The weak dollar is something. I mean, gold going up and all that. It's all tied in, but it also helps foreign company earnings, right? It also helps U.S. multinationals who have a lot of revenue outside, because if the U.S. dollar weakens, local currencies abroad go up.
Yep.
That helps profit growth. Right, that's a tailwind there, and it's also a tailwind for international equities. If foreign currencies are appreciating, that's a little bit of a boost. It's a tailwind for international stocks that are priced in US dollars.
No, well said there. So the last thing, there was virtually no chance of a government shutdown a couple weeks ago because the government's funded through the end of this month, and then everything going on in Minnesota. Not going to get too political on this. There's some issues going on clearly in Minnesota, but there's issues with the government saying we're not going to fund, Department of Homeland Security anymore. So we're going to shut the government down. Not our job to have an opinion on that. Our opinion is, Sonu, what does it mean if we have a partial government shutdown starting in February?
Very selfishly, very practically for myself, it means I will get PC inflation data, but I may not get payroll data to look at.
Oh, that's what it means to you.
Because
that's such a Sonu answer.
Because the Commerce Department is funded, and this gets to you were talking about a partial government shutdown. What does that mean? The Commerce Department is funded, but the Labor Department, which releases payroll data, that's not funded. BLS is not funded. Pentagon's not funded yet. Look, I think the odds of a shutdown are probably about coin toss right now, maybe 60%, slightly ahead of a coin toss, but I think they come to a deal fairly quickly. They figure this out. It looks like everyone's kind of on the same page, making the noises. Like, I think back to what happened in September, and everyone was in their own corners. They're like, you know what? Screw you. We're not talking to each other. Right. There are a few groups always talking to each other, but for the most part, I think they were pretty far apart. This time, I don't get the sense that that's the case.
Well, yeah, I mean, we half joked the government shutdown. I've got the data. We can put this chart up, actually, Drew, and I know I sent it. It says, I said not all shutdowns are bearish. There's tons of shutdowns since the late 60s. We gained 2.5%, Sonu, during the record 43-day shutdown we just saw last year. We gained 10% during the previous record 35-day shutdown before. On average, yes, sometimes you're higher, sometimes you're lower. I don't think shutdowns truly impact, but what did, I think, help this one open, I guess the one before too, but I forgot this, was once the airlines and airports started 3 to 4 hour waits because of TSA, that's when everybody, I don't care where you sit on the aisle, nobody wants to go to an airport and have to wait that long to miss your flight and be stressed and everything. So is TSA funded during a partial government shutdown? I assume. Maybe we need to look that up, because that might mean maybe this lasts longer, because TSA is what really broke the camel's back on this. But I think you're on to something.
I hope not, because you and I have several trips in February coming up.
Yeah, I'm going to see you in Florida. Not Florida, wrong one. I'm going to see you in California.
San Diego.
Yeah, California. I don't know where we're going. I'm on.
And then Florida after that, a month from now.
That's what I was getting confused by. Yeah, but yeah, so you and I.
Actually, we can promote that as well. We probably already mentioned that.
Well, go ahead. Take it away. Go ahead.
Yeah, March 10th. Is it March 10th? March 10th will be. I don't know if this is actually happening on Miami Beach, but I think it is. So I'm going to say future proof. We'll be there. Future proof citywide. We'll be there at the conference. Rand and I will be doing Facts versus Feelings live on main stage. So yeah, come out and say hello.
Yeah, I think that Tuesday, whatever that date is, that Tuesday, we'll be at 9:00 in the morning. There's 3 main stages, and we're at one of them doing our podcast. Obviously, that's subject to change with everything I just said, but that's the way we understand it. So listen, the government shutdowns out there. We've talked a lot about government shutdowns before. They're not fun. They bring up a lot of emotion, but at the same time, from a purely investing point of view, they cause a lot of drama, but honestly, they usually don't slow things down.
They cause drama in my life.
Yeah. Yeah.
I mean, I'm sorry. I'm just being very selfish.
Because you can't get your data. You can't. That was the joke for 43 days. Sonu did nothing at the end of last year.
I could have gotten fired.
Yeah. You'll get fired for something else someday. Probably something I did, and we'll both go down together. But that's all right. We'll have fun doing it. All right. Anyway, anything else you want to wrap this up with, Sonu?
No, I'm looking forward to seeing you and several of maybe Carson advisors in San Diego next week. So we're doing Facts versus Feelings live from stage. So, hey, this is the perk if you're a Carson. So come talk to our team if you're interested.
Absolutely. Yeah. CarsonGroup.com. We'd love to talk a little bit more. If you're a client and you're not too happy with your financial advisor, we have more than 500 of the very best financial advisors all over the world, and they work closely with Sonu and I every single day on the research side of things. And we talk a lot on this podcast. We do manage real money. Our models have done very, very well. It is what it is. I mean, we're proud of that. So that's another little perk. And yeah, got some flights coming up. I fly to California tomorrow to go see Joe Morgan, a great partner for Carson.
Yeah, say hello to Joe.
I will. Yeah, Joe always treats me right. He knows. I said, Joe, I work for food. He knows. I fly to California. You better feed me good. So he knows how it works.
Both.
So that'll be a lot of fun. And then we get to go to California to see many.
I have 3 trips to California. I mean, I was in California last week. I mean, shout out to our friend Derek Pesta as well.
Yeah.
It's always nice seeing clients. And by the way, not to keep going on about this, but we started with gold. I got so many questions about gold, but I didn't get the sense that people were invested in gold. They're like trying to figure out, should we buy gold now? And that's, my perspective on that is, look, if you think gold is a good place in your portfolio, and if you're going to hold it for a long time, let's say 3-5 years, something like that. Yeah. And you've talked about how we think this is a commodity super cycle is for things like gold. Right. Yeah, you know what? Maybe it doesn't matter. You don't have to wait to buy the dip. You can always average in, dollar cost average in, things like that. Buy it, right? If you think it has a good, nice place in your portfolio, do it. I wouldn't get too crazy with, it's up a lot. Yes, it is up a lot. But is it going to go down? I have no idea. But I think the general trend direction is up.
Yeah. Well, I think, we've talked about that before, but if this gold bull market ends like today, it'd be like one of the shortest bull markets. We've got gold data going back like hundreds of years. It's out there. And you can see once these things break out and start to go, they tend to go higher. I mean, think about silver for a second. Peaked at 50 in 1980, peaked at 50 in 2011, just recently broke out above 50, and now you blink and it's at $120, So again, it's all relative, yes, but I think this is a commodity super cycle, and you want to own some things that if you drop it, hits your foot and it hurts, that's where you want to be. We've constructed our portfolios, our models for our Carson partners and their clients to be in more of a 3% inflation world and a 2% inflation world. That's been working, and we think it will continue to work, but we'll be very clear, we still think it's a bull market for equities as well, which is a good scenario for a lot of different types of investors out there. So, all right, we're hitting right about an hour. We probably need to be quiet. Yeah, I guess I'll just say this Friday is that live stream with Brian Belsky. Please be sure to follow us on our social channels. We'll promote that a lot. It'll be a lot of fun to talk with one of the big bulls that's been out there, but also he's been bullish and been very right for a while. I know he's got a big theme. We're in a major super cycle for a couple decades of a bull market. He's been saying that for a long time and been proven right. We'll ask Brian how many more years he thinks is left this coming Friday. Bring a drink. We'll have a laid-back happy hour conversation. See everybody then. Enjoy. Sonu, I'll see you in California, but I'm sure I'll talk to you before then. So, all right, take care, everybody. See you next week. Goodbye. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.